Alright, so again, it's your boy NatureAkaNature. You already know what time it is. Let's get straight to the business. So, I know about basically the fundamentals, the basic triple stick candlestick patterns, double uh, double stick candlestick patterns, single candlestick patterns. I know about the patterns. I know about you know uh, moving average. We know about the basics. Okay, so if we want to start diving in more and more, alright. Um, so to help y'all with the trade. So the next thing I believe that y'all need to really focus on is, which it seems like a lot of traders have a problem with this, is finding entries, perfect entries, and forex. So forex trading entry points. A forex entry point is a level or price at which traders enter a trade based off of buy or sell. So it's an entry point, and it's a level of price in which traders enter a trade from a buy or sell. Deciding on a forex entry point can be complex for traders because of the abundance of variables inputs that move the forex market. Yes, a lot of things that move the forex market. So it's hard to find perfect entry points. I'm going to show you guys how to find those entry points better. So let's go to right here. My secrets into making perfect trading entries. As you probably already know, trade entries are very important in determining whether you succeed or fail as a trader. One good trade entry can make or break your month in the market, yet traders tend to take entries for granted by assuming they are easy parts of trading and putting little thought into getting the best trade entries possible. A better trade entry can significantly improve the risk reward potential of a trade as well. Risk reward potential is, the maximum potential that you can get from that trade. You can improve it. Better trade entries can significantly improve the risk reward potential of a trade, as well as you getting better stop losses, placements, which can decrease your chances of getting stopped out and taking big losses and big moves in the market. So, what are some things that you can do to improve your trade entries? Today's lesson will outline 4 tips for making better trade entries that can help improve your trading results as you can practice constantly, consistently. So, using limit orders to get better prices is one of the things that you can do. You can get a limit order. A limit order is a pending order that places above or below a current market price. So, um, limit orders are buy limit orders, sell limit orders. We've gone over a little bit. We're going to dive in a little bit more about limit orders, buy limit orders, sell limit orders, just like so you guys can get the definitions and everything. So, a limit order is a pending order that you place above or below a current market price. It's a pending order. It's pending. It doesn't hit until price actually hits your limit order, your buy order, or your sell order. So it's pending until then. It's a pending order really until price hits above or below. Once price goes below or above and it hits your limit or sell, your buy or sell order, depending on which direction you're trading, then it will be active. So it's a pending order really. So if you're trading long, you place a limit buy entry below the current market price. So if you're trading long, right, and it's long, it's a buy, you're expecting the market to go up in an uptrend. So when you're expecting the market to go up in an uptrend, the market won't just go straight in an uptrend. So what it's saying is, if you're trading long, you want to place your buy entry below the current market price because price won't just go straight up. Price will always pullback, called pullback. We went over that that was some of the basics that we went over was pullback and breaks. When price pulls back, so before it breaks through, um, it'll pull back. So on a pullback, this is why you don't want to push your buy order at the top, and then expecting it will just go up there, and then eventually hit your buy order. You want to put it on a pullback so you can get the maximum amount of money. So price will go up and then it will pull back. You'll push your buy limit. That's why they say if you're trading on, you push your limit buy entry below the current market price. So when price finally does pullback. And when price rotates down, finally pulls back into your limit buy order, is going to pull back into your limit buy order, which will get filled. It will get active. It will no longer be pending. It will be active. And you know, it will, once it's active, it hits your buy order. It rotates down to your limit order, your buy limit order, because that's what price will do. It'll pull back. It'll rotate back down to your buy limit order. Wait for the pullback. Okay, just don't get into the market at any given time. Okay, so wait for the pullback. Wait for price to rotate back down into your limit buy order, and then you will get filled. Then you fill. Then it will get filled in long. You're in the trade. Okay, same thing as you're trading short. Your short means sell. If you didn't know it, it's a place limit sell entry. So you want to place your sell limit entry above the current marketplace. As a buy, you place your buy limit order below. Now, as a sell, you want to place your buy entry order above the current market price. The price on the downtrend won't just continue going down. Most likely, it's going to pull back up, because price always pulls back up. Once price pulls back up, that's why it says you place your limit sell entry above the current market price. So when price does finally, you know, when price moves higher and finally does move higher and pull back on a downtrend, it will pull back up. On an uptrend, it will pull back down. So when it finally does pull back up, it will hit your limit sell order. It will activate your limit sell order, and you know, you want to get in on a pullback. You want to get in on a pullback. You just don't want to get in an entry. That's a quick way to lose your money. You know, so usually it's like perfect ways to get into the entry is by waiting for price to, you know, if you're doing sales, you wait for price to the current market to move back up, and then you get in for sales. You put it in, if you have a sell limit order, and you can do this manually or you can do it with the sell limit order. The sell limit order allows you to, you know, not be able to look at your phone. You don't have to look at your phone because you already put a pending order in, a pending sell order in. So when price does finally hit your pending order, you don't have to do nothing. You know, it will alert your phone, or you'll you know. So that's one of the ways you can, you know, to get perfect entries. You wait for the pullback, which we go over, and you know, in the OnlyFans, we already went over pullbacks and entries and breaks. So limit orders can give you power to get in a trade at the price that you're choosing. Okay, you can put a buy limit or a sell limit order at any given price level. Okay, so you want to look at price. You want to look at the where you want to put in this limit order. You put this pending order. You put it in anywhere. Okay, it gives you the power at the price that you're choosing. The only catch is that it may not hit your sell limit order. You might dismiss that trade, or it may not hit your buy limit order. You might dismiss that trade. It may not fill. You know, it might not hit. It might not become active. This is why it's important to, you know, to study the market and to know, you know, good entry prices and good entry points to get into the market, because sometimes it won't hit your trade, and but if it does hit your trade, it does fill in, you know, you got a good entry point or a good entry price and a better stop loss. You always put your stop loss in. The price moves fast in this market. Forex moves fast. Depending if you're trading stocks, you're trading crypto, you're trading currencies, you're trading gold, silver, so it moves fast. So stop loss is very, very important. We use all these things as traders to use everything, okay, to our advantage. So then if you have just enter in at the market or on a stop entry, you know, it'll help you, you know, to put that stop entry in. So we use everything. Want to get an example of using limit orders to get a better entry point or entry price? This is discussing his trade entry trick, which is the trade entry trick essentially entering a price action signal approximately 50% retrace. Entering a limit order price retrace to 50% level of a pin bar, for example, and you know, 50 Fibonacci price will retrace. Price will pull back to the 50% extension, the 61.8 extension, it'll pull back before going to the 2761.8 extension. It'll pull back, price will pull back to the 50% level. So this is also very important to understand. Um, you know, this is one of his things that I also agree with is to, and I'm gonna also tell y'all the pullback levels in another video about breaking out Fibonacci. But you want to wait for a price to pull back about 50% to enter it on a limit order once price retraces 50%. 50% it retraces, then so this can get you a better entry because it significantly improves the risk reward ratio when you wait for the pullback and just getting in the market just because you think price is going in that direction and it's really not. You want to wait for price to pull back before if you want to be successful in this market and make money from home, you want to wait for a price to pull back. So a trade by allowing you it allows you to have more room. It allows you to build more, to actually be comfortable. The price will pull back unless you have enough, which is stupid because you're just losing money at this point. Don't take, risks that you don't have to take. So by allowing, the trade to actually hit the 50 level and retrace back first and pull back before you get into the market, you're allowing yourself a more likely chance to make two or more reward ratio. You put your stop loss below, and you're more likely you'll make 2R, which is two risk reward ratio or more, a 2 to 3, a 2 to 5, 2 to 6, 2 to 8, or more on your trade. Okay, sometimes you can do 2 to 10, 2 to 12. Okay, those are more rare, but you can. The other big advantages of getting a better entry, a limit order off the 50% retrace trade entry trick is that it gives you more, like I said, flexibility. It gives you more flexibility, more comfortable in this trade. You're just not, running with your head like a chicken with your head cut off. Okay, you're more comfortable. You also put your stop loss in case price does a fake out or does anything that goes against you. You got your stop loss in there, so you're making some money. Okay, so you either take a trade for a tighter stop loss, as we discussed above, or you can use a normal distance stop loss. An example of the pin bar. So a normal stop loss distance would be a full length of a pin bar from high to low, as I discussed in the trade entry article. When you wait for the pullback, it gives you more of a breathing room. It gives you you're more comfortable in the trade. So remember, limit orders allow you to let the market come to you by only entering if the market retraces. That's the benefit. Or you just wait for the market to retrace, the price to pull back, like we taught you guys in the OnlyFans. And once the market retraces and pulls back, then you get in. It allows you to have more freedom. You can also do, put a limit order in. Like I said, you can put a limit order in, allows you to have more freedom too in the market. You don't have to watch the market. You don't have to watch it. You can just put a limit order in, and I'm going to teach you how to do that. And so it is going to alert you that once it hits your limit order, that price is moving and is going in your direction. So remember, limit orders allow you to let the market come to you by entering Austin retracements. Market retraces the price of your choosing. If you prepare and if you study, then you won't miss the trade. And the advantages is better. It's a better reward risk ratio when you enter the trade, and it allows you to increases your flexibility. And when you enter the trade, with a strategy, with a plan. So this is what we're trying to do: is give y'all some type of strategy or plan to help you when it comes to your trade. So set up trades at the end of the day. This is another way that you can find entry points in a trade. I'm going to also give y'all a lot of more examples of finding entry points in a trade. So is to wait till the market ends. The market ends. The bank closes at 5 p.m. New York time. analyze the market once it closes at 5 p.m., and set up your trades. Set up your trades. It's very easy to be efficient this way and to improve your trading entries if you know, once the market closes at 5 p.m., session doesn't start. The London session doesn't start until 2 o'clock. So you have, and the New York session doesn't start until about 6 o'clock. So you have time. The Asian session starts early, but you have time to between the London and the New York session. Once the market closes at 5 p.m., to easily study the market, define trades, define trade entries, define person entries to get into. So this is what we have to do. We have to have a plan when it comes to trading. We just don't get in a trade just because. That's how you lose money. Trust me, I've been trading for about a year. So I'm very effective, and I'm making more money doing by my rules. Okay, so I made a lot of mistakes that you guys are obviously going to benefit off of my mistakes, because you don't have to go through those mistakes no more, because I'm going to teach you right now the mistakes I learned, so you won't make those mistakes. And which is one of the mistakes that I learned was just getting in the market too early. Getting in the market too early, not really having a trading entry, a trading plan, a trading strategy, and just getting into the market too early without, having a plan. With anything, you have to have a plan, you have to have a strategy. So to remove the noise and the mental confusion that comes with trying to trade just by just getting in, it's better to have a strategy. Set up your trades at the end of the day. Each day, you want to set up your trades. At 5 o'clock, you want to set up your trades for the next day. At 5 o'clock, you want to set up your trades for the next day. So monitoring day also helps you to avoid temptations of fiddling, beginning to trading unnecessarily, just making trades that's unnecessary because you studied the trade. And you can avoid these mistakes. You can avoid the headaches, the confusion, if you have the strategy. If you say, okay, this is where I'm going to put my entry at. This is where I'm going to get out of the entry. So this is more psychological. 95% of trading is psychological. Understanding, what you're going to do is really how, this works. Because it's all up to you and how, your psychology. So psychology is very, very important when it comes to trading, being a day trader, and your psychology goes up and down when it comes to trading. So you want to make sure your psychology is good, that you're feeling comfortable when it comes to trading. This is why we're doing all of this, so it can help with your psychology, help you when it comes to trading. You feel more comfortable to get in this trade because you study the market, you set up your entries, you set them up, right? So that's another example of how to find person entries in the market, is just to, at the end of the market, at the end of each day, to find out, look at tradingview.com, look at tradingview.com, look at the news, look around, use as much as you can. You want to identify the trend, you want to identify key levels. Okay, so the daily time frame chart carries more weight, because the daily time frame chart, which is the 1 hour, the 4 hour, the daily, and the day chart, and the weekly chart, it gives you more, especially the 1 hour, 4 hours, and the daily. Even the weekly, it gives you more irrelevant of what's going on in the market right now than the lower time frames, because the lower time frames can be very confusing. We usually use the lower time frames to get in on entry points, on purchase points, on the 15 and the 5, and the 30. The 1 minute is too fast. You can use the 1 minute, but I suggest you don't use the 1 minute. Too fast. So just be very aware of that. Lower time frames can give you perfect entries, but it's better to use the daily, the 4 hour, 1 hour, and a day chart to significantly improve your trading, because if it's going up for the day, it's going up for the day. And you can see that on a daily chart, you can see that on a 4-hour chart, you can see that on a 1-hour chart, that is going up for the day. Okay, compared to the 15, compared to the 30, compared to the 5 minute or the 1 minute. That, even though it's a lower time frame, and you will think that, okay, it's a lower time frame, and we do use the lower time frames to, scale in and to find better price entries. You have to be very careful. If you really want to know the overall trend and the direction of the overall trend, you want to identify the trend line. You want to, draw the trend line to see if this is an uptrend or a downtrend. And you want to look at the daily, the 4-hour, the weekly, trading view, everything. So this is just a very act of focusing on the daily chart and seeing if it's going up significantly. This will improve your trading entry. Okay, this will very much improve your trading entry. Looking at the daily, the 4-hour, and the 1-hour. Think of the daily chart as a sort of a natural filter for bad trade entries. Since it's a filter, it filters out the noise. Look at the 15 and the 5 minute daily and the 4-hour and the 1-hour. It defeats the purpose of you having a bad trade, because usually, if you want to know what's going on in the trade, you want to look at the 4-hour and the daily and the weekly. It filters out all the noise and the irrelevance of a lower time frame price momentum as a result, as looking at the daily chart, and the result of signals, patterns, single stick candle patterns, double stick candlestick patterns. So signals are important. Candlestick patterns, dojis, marabozal, inverted hammer, hanging man, shooting star, inverted hammer, hanging man is at the end of a downtrend, inverted hammer is at the end of an uptrend, possible reversal that's going down, hanging man, downtrend, possible reversal going up. You want to look at the patterns, marabozal, depending if it's going up. If it's green, it'll be a long candlestick. If it's going down, it'll be a long red candlestick. So these are Japanese candlestick patterns that also take a place. You have to look at everything. So you have to look at the signals. Double candlestick patterns will be bullish and bearish engulfings. When one candlestick engulfs the second one, tweezer tops, tweezer bottoms, tweezer tops. Meaning that reversing down, tweezer bottom means reversing up. Then we have morning star, evening stars, black crows, 3 white soldiers, 3 black crows. 3 black crows mean if you see 3 black candlesticks in a row, that's a pattern. That's a triple stick pattern. That's meaning that price is likely to continue in a downtrend. If you see 3 white soldiers and you see 3 candlesticks that's white, or 3 candlesticks, that's a triple candlestick pattern. That's one of the patterns so these are signals that we look at too in determining on what price is doing. So we want to look at signals, we want to look at the daily chart, you want to and to help you, you want to look at everything. So when I say the lower time frame, I'm mainly referring to the intraday trading frame under the 1 hour. So the 30 minute, the 15, and the 5 minute. The 1 minute, and you can also see, but if you wanted to always go back to the 4 hour, always go back to the 1 hour, the daily, to see what price is really doing. Okay, we just use the 15 and the 5 hour to get in on entries. So the next one will be to wait for a confluence using the TLC principle. 90% of traders take the use of the TLC model. The TLC model says for trends, you want to identify the trend, you want to identify key levels, which we're going to talk about. Price will go to a key level of resistance or support before breaking through. key level, so go to a key level of support, the last support, or the last resistance. And also look at for trade signals, triple stick candle, 3 black crows, 3 white soldiers, bearish engulfing, bullish engulfing. So those are the 3 things. When you look at the trend, you want to identify the trend, you want to identify the key levels and the signals of those the patterns. So when you have all these 3, or at least even 2 of these points alignment, you have a perfect storm. You have a better chance of trading opportunity. So let's take some examples of trades that have the TLC fluent. So the TLC is the trend, the level, and the signal. So the trend was clearly bullish. Bullish means uptrend, bearish means downtrend. So it was clearly bullish. The key level was 1.660, and the signal was formed on the key level, which you can see right here. It formed a hanging man. Okay, hanging man is formed. A hanging man means that sellers try to push price higher. See that long wick means that sellers try to push price higher. Price lower, but it ended up. You can see it ended up pushing. Buyers ended up pushing price back up at the end of that trade, which is when you see that, when you see this hammer, it means, and you see the box, you see it go all the way down, then it goes back up, and the box fills. That means that that it wants to continue going up. Okay, so in this example, you can see that it's a bullish. It's bullish. It's bullish. It's going up. The key level is 16. That's the key level that price went to. The key level, you can see the little blue boxes. Price went to that key level a few times. It went up there one time, then went back down. Then it went to it again right here, and then it went back down, and then it went to it again before going back up in the uptrend. So, and then you can see, if you draw a trend line from the first arrow to the last arrow, you can see it's an uptrend. So it's identifying the trend, identifying the levels, and identifying the signals, the patterns. So these will help you identify and come up with more perfect entries. And I'm going to also dive in a little bit more on the next video about perfect entries, and then we're going to talk about exit strategies, exit entries, when to get out of the trade, which is very important too. So the chart example below shows another example of a TLC trade, a trend, a level, and a signal. This shows another example. The bullish means going up again. We wanted to identify the key level. There's the key level on this. This is on New Zealand JPY. So NZD JPY, the key level 79.8866 or 866. It's an uptrend. Once you find the key level, price will go to that key level before breaking through. Then it'll pull back, and then it'll continue back up. It'll pull back to that key level, because price is the market has to be fair to everybody, all the buyers and sellers. So if you're in a buy entry early, like I probably would have got in a buy entry. You see where that arrow's at? The first arrow at the bottom. I would have got in once I seen that Maribozel, with that bearish, that bullish engulfing, which is when one candle engulfs the second candle. So you see that black candle, and then you see the white candle engulfing that. That's when you would have got in. So you would have got in right there, which is like a more of a perfect entry. Then you would have been, you don't have to, you'd have been good. The price never went back down to that key level. So you would have been good. You could have just traded out that trade or long position. But for people that missed that trade, which some people missed that trade, price pulls back. So you can see as price pulls back, it made another hammer right here. As you can see, it made another hammer. Okay, pulled all the way down. Sellers tried to push price all the way back down, but as you can see, that little box right there at the top means that buyers push price back up at the end of the closing period, which is a clear continuation signal. It's a single candlestick pattern that signals that prices wants to continue going up. So that's a hammer. See it's poking out, it's hammering out at the bottom. That's another way you can know also. So in this example, we are looking to show a clear example of using the TLC, the trend line, and the trend level and signals. You can see the TLC, the trend levels and signals. You can see where the trend is at, and you can see where the level is at, and you can see where the signals at. Same thing on the downtrend. I'm going to show you an example of the downtrend. Alright, so you want to identify a trend first. Identify the trend. It's going down. Obviously, it's a bearish trend, downtrend, going down. Next thing, you want to find your key levels. Once it passes your key level, boom, you know that price is going to, once it passes your key level, price is going to most likely the high possibility that the trade that you enter, you're good. It's going to go past that. Once it goes past the key level, then you can either put another sell in. Okay, you want to usually push your sell in once you see that right here. As you can see, it made an even star, which is a triple stick pattern, and it also made a bearish, a bearish engulfing pattern. You see where it's always at the type, and you see the long black candlestick engulfing that second candlestick. So once it made these patterns, you identify the trend, you got the key level, and it gave you a signal. This is a signal right here. This is called an inverted hammer. An inverted hammer is when price is the opposite of a hammer. Hammer is when it's hammering down. Inverted hammer is when it's hammering up. It's inverted. It's a reverse hammer. So it's hammering up. This signifies that buyers try to push price all the way back up, but sellers want to push price all the way back down. When you see inverted hammers on a downtrend, it's going back down. It's going to drop immediately back down, which it did. Okay. Before you see some type of signal or reversal pattern that's going to tell you that that trend is done, and then once they go back up. So inverted hammers, you're going to see that. If you see inverted hammer, 9 out of 10 times, it's a single candlestick pattern, but 9 out of 10 times when you see inverted hammer, it's going down. If you want to get in for sales, you want to buy for sales, not for buys. Hammer is for buys, inverted hammer for sales. So you want to identify the trend, the key levels, and the signals. So they showed us, we got our trend, we know our key level for silver. So this is silver, AAG, USD is silver. With our key level is 19.8817. Once it passes through the key level on top of an inverted hammer on top of the key level, it was an inverted hammer made on top of the key level. Definitely means it's going back down. It goes back down. You can see it. So yeah, you want to identify that. Once you see that inverted hammer, that signal, and you identify the trend, you're pretty much good. The key level too is also important. So you want to wait before you just get in the trade. Okay, I probably would have been an aggressive trader. I just would have got in right off the bat. See, sometimes it won't be a big pullback, as you can see in this one right here. It was a big pullback before going back up. And this example right here, it wasn't really a big pullback. It went down and then it pulled back up a little bit. It kind of consolidated, and then it just dropped back down. Wow, it went to drop back down. Made that signal, that inverted hammer signal. Once I seen that, I'm in there for sales. And continue back down for about 1 to 3. If I would have gotten at the top, of the uptrend, at the downtrend, then this is the easy 1 to 5, 1 to 6 risk reward ratio. So if you would have gotten at the key level, still could have been a 1 to 4, 1 to 5 reward ratio. And you get in once you see price starting to go back up. So have a simple trading strategy, understanding trend lines, signals, key levels, having, the market ends at 5 o'clock. You want to make this a religion. You want to make this, trading is about being disciplined and understanding the fundamentals and the technicals that come, and technical analysts, analysis that come with trading. So it's more about being disciplined and being consistent. So if you're someone who's very disciplined to be very consistent, you won't have a problem with this. So it's not about finding a trade and just placing. No, it's about actually finding the right trade, then having a confluence, having a plan, to pull that trade, to actually get in that trade. Either if it's do a buy limit, sell limit, manually looking at the chart, studying the chart once the market closes at 5 p.m. These things are very, very important. And I'm going to also give you some more examples of why it's important to, and how you find entry points, better entry points, in your trade. So, plan, have a plan, and look at signals. Even if you have somebody that pays for signals, you pay for signals too. You use everything to your advantage. I'm not going to tell you anything wrong. So good signals from bad signals will also hold accountable. Checklists might consist of several images drawing, your key levels, drawing your trend lines, set up your chart, drawing showing your ideal trade, set up your chart conditions with some basic wording such as, and you can do this all on TradingView. TradingView has the chart. Now we're going to also be doing TradingView soon. And you're going to see more and more of me trading. And you guys can get a better feel with, acting like you trade. But we need to understand, the words and everything, before we just go there. So you have a better understanding when I say these things, what I'm doing. Okay, so this won't sound like blah 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 blah. So this is why we need to understand, trends. We need to understand the key levels. We need to understand patterns, single pattern, double pattern, triple pattern. So you want to find the nearest key level, you want to find a trend, and you want to find confluences on the chart that show you that, or patterns on the chart that shows you that, where to possibly get in or consider to get in on the trade. So if you're correct and you don't risk your risk reward, money management is the same thing as risk reward. If you have the right risk reward, or you have, your account, you have enough money in your account, then this won't be a problem. And your risk reward ratio will make sense, and you'll feel better about your trade, once you put the right, size position too. We're going to talk about that too. Size position, what is the right size positions to put in. So if you put your risk reward ratio in, and you identify the key levels, the trends, the patterns, your risk reward ratio will make sense and it will increase. So set up orders, place trades. It's, I recommend that you start off with one trade. If you're a newbie, start off with one trade a day, a week, okay, before you start trying to trade Bitcoin, crypto, and everything. So if you can do that, that'll be good. Also, it's important to personally, just have a plan, customize a plan, write it down, okay, and design it for you and your personality, your psychology. So of course, if you have not yet mastered the trading methods, you will be able to get good entries in the market once you understand how these entries, or these 4 ideas. Once you master those 4 ideas in the market and trading, you'll be a master at trading the market. You'll be able to get good entries in the market. Thus, this is, having a plan. Just having a plan, you'll be able to have a better chance of making more money in this market than just getting in and just thinking it's going up, or it's going down. The market just doesn't go up, and the market just doesn't go down. Okay, it pullbacks, it makes patterns, does a lot of things. So it's important we went over this money management, so you can be an effective trader, such as price action and trading strategies concerned. So this was um, this was 4 secrets to making perfect trade entries. I hope this video helped. In our next video, we'll talk more and more about trade entries, in Forex. So, all right, gang.